It is 1998. A fund called Long-Term Capital Management is packed with Nobel-level brain power, elite connections, and models that look airtight on paper. Then Russia defaults on its debt, spreads blow out, liquidity vanishes, and the fund starts to implode. Not because the trades were crazy in isolation, they were levered. They borrowed so much that a normal bad week became a life-ending event. If you have ever thought, I am right about the direction, so I should size up, that is the doorway into leverage risk. When I say leverage, I mean using borrowed money or embedded borrowing to control more assets than your cash would normally allow. Margin loans are the obvious version. Options and futures are the stealth version because they give you big exposure for a small upfront cost. Leverage is not automatically evil. It is a tool. The problem is that it changes the shape of your outcomes. It makes small errors fatal, and it makes normal volatility feel like a crisis. Volatility is how much prices wiggle around. In plain English, it is the size of the typical up and down moves. A stock that moves 2% a day has more volatility than one that moves 0.5% a day. Leverage multiplies that wiggle on your equity. If you are 2-to-1 levered, a 10% drop in the asset becomes about a 20% hit to your capital before costs. If you are 5-to-1 levered, it becomes about 50%. That's where people get trapped. They think they are taking a little more risk for a little more return. In reality, they are crossing a cliff edge where the math stops being forgiving. Drawdown is the percent you fall from your peak to your trough. It sounds like a statistic, but it is also a psychological event. A 50% drawdown requires a 100% gain to get back to even. That is not motivational poster math. That is arithmetic. Leverage accelerates drawdowns, and big drawdowns change your decision-making. You stop thinking in probabilities and start thinking in survival mode. This is where uncertainty matters. Uncertainty is not just not knowing the future. It is not knowing the range of possible futures. Many investors plan for a world where the next year looks like the last 5 years. That is a base rate error. Base rates are what usually happens in similar situations over long history. The base rate for markets includes crashes, liquidity freezes, and regime shifts. A regime shift is when the rules change, like inflation returning after decades, or correlations flipping during a crisis. Correlation is how assets move together. In plain English, it is whether your positions are likely to lose money at the same time. In calm markets, correlations can look low, so a portfolio looks diversified. In a panic, correlations often jump toward one. That means your portfolio that looked balanced suddenly behaves like one big leverage bet. LTCM learned this the hard way. They had many positions that looked diversified, but they were all exposed to the same thing: a flight to safety and a collapse in liquidity. Liquidity is how easily you can sell without moving the price. Liquidity risk is the risk that you cannot exit when you need to, or you can exit only at terrible prices. Leverage and liquidity are tied at the hip. When you are levered, you do not get to choose your timing. Your lender, your broker, or the market chooses for you. Margin calls are not a moral judgment. They are a mechanical process. If your equity falls below a required level, you must add cash or sell. In a fast sell-off, forced selling pushes prices down more, which triggers more margin calls. That feedback loop is reflexivity. Reflexivity means prices change behavior, and behavior changes prices, creating a self-reinforcing spiral. I want you to picture a simple case. You buy a broad stock index with 3-to-1 leverage. You might think the market has a long-term upward drift, so this is just a faster path. Then a normal bear market shows up. The S&P 500 fell about 57% peak to trough in 2007 to 2009. With 3-to-1 leverage, ignoring path effects, you are effectively wiped out. In real life, it is worse because you get margin called long before the bottom. You do not get to hold for the recovery. Leverage turns a long-term investment horizon into a short-term liquidation risk. This is why Warren Buffett talks about staying in the game. He has said in public letters that leverage can make you look smart for a long time, then erase you fast. I am not quoting him word for word. I am pointing to the principle. If you cannot survive the bad decade, the good decade does not matter. Charlie Munger was blunt about this too. The first rule is not to interrupt compounding. Leverage is one of the most common ways people interrupt compounding. Now let me bring it closer to the retail world. Options. People see a call option and think it is safer because the most you can lose is the premium. That is true for that one contract, but the leverage is embedded. A small move in the stock can create a huge percent move in the option price. That is convexity. Convexity means your gains and losses do not scale linearly. The curve bends. Options have time decay too, which means the option can lose value even if the stock does not move. So you can be directionally right and still lose money. Leverage plus time pressure is a nasty combination for decision making. Futures are similar. They are efficient tools for hedging, but they are pure leverage instruments. A small adverse move can trigger a margin call. Many blowups are not about being wrong on the thesis. They are about being right too late. Timing becomes a hidden risk factor, and timing is the hardest thing to control. If you want a clean case study on incentives and failure modes, look at Barings Bank and Nick Leeson. A trader took large derivatives positions. Losses were hidden, controls failed, and the institution collapsed. The lesson is not that one person was reckless. The lesson is that leverage plus weak controls plus a culture that rewards short-term gains can create a disaster. Operational risk is the risk that processes and controls fail. In plain English, it is the risk that the plumbing breaks. Leverage magnifies plumbing problems into existential problems. Another angle is the Kelly criterion. Kelly is a formula for sizing bets to maximize long-run growth. In plain English, it tells you how big to bet when you have an edge. The catch is that it assumes you know your edge and your odds. In markets, you rarely know them with precision. Overbetting Kelly is a common path to ruin. Risk of ruin is the chance you go broke or get forced out before your edge can play out. Leverage increases risk of ruin faster than most people intuit. You can have positive expected value and still go bust if you size too large. Expected value is the average outcome over many repeats. In plain English, it is what you would expect if you could replay the same bet thousands of times. Markets do not give you thousands of clean repeats. You get one path with clustered volatility. Volatility clustering means big moves tend to follow big moves. That is why leverage is most dangerous, right when you feel you need it least. Calm periods invite higher leverage, then the regime shifts and the bill arrives. I also want to talk about behavioral finance because leverage is not just math. It changes who you become under stress. Loss aversion is the tendency to feel losses more strongly than gains. With leverage, losses arrive faster and feel more personal. You start averaging down because you cannot accept being wrong, or you cut winners early to feel relief, or you double up to get back to even. That is not strategy. That is pain management. Leverage turns normal human biases into portfolio-level failure modes. So what do I do with leverage as a risk manager mindset, not as a thrill seeker? I treat leverage as something you earn the right to use, and even then I treat it as temporary. I assume I'm wrong about timing. I assume correlations can jump. I assume liquidity can disappear. I assume the tails are fatter than my model. Tail risk is the risk of extreme outcomes, the stuff that happens rarely but hurts a lot. If you are levered, tail risk is not a rounding error. It is the main event. Look at George Soros and the famous macro trades people talk about. The public story is boldness. The quieter story is risk control. Soros has spoken publicly about cutting risk when he is in pain and pressing when the situation is asymmetric. Asymmetric means the upside is large relative to the downside. Paul Tudor Jones is known for thinking about worst-case scenarios first. Stanley Druckenmiller has talked about concentrating when conviction is high, but also about getting out fast when wrong. The common thread is not leverage. The common thread is respecting the ability of markets to humble you quickly. Ray Dalio popularized the idea of risk parity, which is a way to balance risk contributions across assets. The key word is risk, not dollars. A low volatility bond position can be sized larger than a high volatility equity position to equalize risk. That can involve leverage. It can be done prudently, but it is still exposed to regime shifts like a sudden inflation shock that hits bonds and stocks together. Again, leverage is not the villain. The villain is assuming the world will stay friendly. If you are a normal adult investor with a job, a family, and limited time, the most practical question is simple. If this position drops 30% in a month, what happens to me? Not emotionally, mechanically. Do I get a margin call? Do I have to sell? Do I lose sleep and start making bad decisions? If the answer is yes, you are not sizing a portfolio. You are sizing a stress test. I think of position sizing as the volume knob on uncertainty. Position sizing is how much of your capital you allocate to an idea. With leverage, the volume knob can jump from background music to permanent hearing damage. The goal is not to avoid all pain. The goal is to avoid forced selling. Forced selling is where good investors turn into bad investors because the market takes away their time horizon. Here is the quiet truth about leverage. It is most tempting when recent history has been kind. It is least available when you actually want it. Banks lend freely into booms and pull back in busts.